Ladies and gentlemen, good day and welcome to the Triveni Engineering and Industries Limited earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rishabh Barar from CDR India. Thank you, and over to you, sir.
Thank you. Good day, everyone, and a warm welcome to all of you participating in the Triveni Engineering and Industries Q1 FY2026 earnings conference call. We have with us today Mr. Tarun Sawhney, Vice Chairman and Managing Director, Mr. Suresh Taneja, Group CFO, Mr. Sameer Sinha, CEO of Sugar Business Group, Mr. Rajiv Rajpal, CEO, Power Transmission Business, as well as other members of the senior management team. Before we begin, I would like to mention that some statements made in today's discussion may be forward-looking in nature, and a statement to this effect has been included in the invite which was shared with everyone earlier. I would also like to emphasize that while this call is open to all invitees, it may not be broadcasted or reproduced in any form or manner. We will commence the call with opening remarks from the management, following an interactive question and answer session. May I now hand it over to Mr. Tarun Sawhney. Over to you, sir.
Thank you. Good afternoon, ladies and gentlemen, and welcome to the Q1 fiscal 26 earnings conference call for Triveni Engineering and Industries Limited. The key consolidated financial numbers for the quarter were that revenue from operations stood at 1,598 crores, with a PBT of 2.9 crores and a PAT of 2.1 crores. The net turnover increased by 23%, which was supported by a 53% increase in alcohol dispatches and a 14% increase in the consolidated sugar dispatches, as well as improved sugar realizations. In the power transmission business, we reported a 15% increase in order booking and a record closing order book of 423 crores, which has improved by 38% over the corresponding previous period. At an overall level, the closing order book of the engineering business stood a shade under 2,000 crores at 1,975 crores, up by 32% compared to the previous corresponding quarter. The debt position of the company on a standalone basis stood at 1,385 crores versus 1,150 crores on the 30th of June 24. The standalone debt for the period under review comprises of term loans of 320 crores, of which 180 are with interest subvention. And on a consolidated basis, our gross debt is 1,688 crores compared to 1,280 crores on the 30th of June 24. The overall cost of funds has been very manageable and stands at 7.3% at the end of this previous quarter versus 7.1% in the previous corresponding period. However, I'm happy to share that from the future perspective over the next few quarters, we will be, because of our debt rating, we will be able to see a decline in our cost of funds, especially when we need it the most. And so that is the expectation from our balance sheet position going forward over the next few quarters. I'd like to take some time to do a business-wise review. Turning to our sugar business, the growth in sugar turnover was on the back of a 14% increase in volumes. That included the subsidiary Shadi Lal, and a 4% improvement in realizations. The segment profit, despite higher volume and realization, declined 80% due to a 7.6 crore declined by 80% to 7.6 crores, and this was due to a higher cost of production of sugar sold in Q1 fiscal 26, which could not be offset by the increased sugar price realization. The cost of sugar sold during the quarter pertains to the sugar season 24-25 and was impacted by the gross lower recovery. So, in a nutshell, the recoveries for the group were 69 basis points lower than the previous season, and that had a direct impact on the cost of production and is the most significant contributing factor for the increased cost of production. With respect to the comment that I made about sugar price realizations at the beginning of the last quarter, Q1, We did see higher sugar realizations that were in excess of 40 rupees. However, as the quarter went on, prices did decline. As there's been a kind of a difference in terms of the demand of sugar across the nation this year, especially during the hotter summer months. And as a result, the prices fell even during the month of May and June, slightly below 40 rupees, 39.50, 39.60 rupees. And so that, of course, was unexpected during the quarter. When I talk about the future, I'll bring you up to date with what we experience right now. But there has been a change in that position, of course, with great support of the DFPD. The sugar inventory on the 30th of June 25 stood at 44.5 lakh quintals, valued at 37.4 rupees per kilo. And the current ex-mill domestic prices for refined sugar are 41.2 rupees, and sulfitation is about 50 paisa lower per kilo, 50 to 60 paisa lower per kilo. Now that, of course, is higher than even the start of prices in April 2026, at the beginning of the last quarter, or just a shade higher. And it is because of the lower quota that has been announced by the government, approximately 10% lower when one compares year on year. Has been the reduction in the quota that's been announced by the DFPD, having a direct bearing on price. And again, this is in reference to the comments that I've made in the past as well. It is a regulated sector, but I repeat that there is huge amount of control that can be exercised by the department, which has a positive impact on sugar prices. And the recognition that sugar prices have to be above a certain level, I think, is a very welcome policy initiative by the DFPD. Looking at the industry scenario, the sugar balance sheet, with an opening stock on the 1st of October 25 of just under 6 million tons, we produced 33 million tons, and domestic sales were around 28.5 million tons. So we're expecting the closing stock of just about 7 million tons of sugar, and this is after considering about 4 million tons of sugar being diverted into ethanol. And these are, of course, our Triveni estimates. Going forward, I think that because of this slightly higher closing stock when compared to last year, despite the exports that have happened over the course of this sugar season, we have seen that little softness that happened in May and June, primarily looking at the inventory balance, the balance sheet of the nation, as well as the crop that lies ahead for the next year, which I will cover in a little more detail when I look at our projections for the year ahead. From an international basis, the global balance sheets pointing to a deficit. As per the latest S&P Global and other balance sheets, we're looking at a deficit of about 4.6 million tons. However, for the 25-26 sugar season, the outlook looks largely balanced. Actually, it looks towards a slight surplus of about 2.9 million tons of sugar. This is primarily due to better crops in three very important countries, Brazil, India, and Thailand, for the upcoming season. International sugar prices have been on a declining trend since January 25, where they had turned bullish in January and February. And in our last conversation, I had talked about our sale of our export quota, which was done at very handsome prices and booked in Q4 of the last fiscal year. But since then, prices have declined, and consequently, I believe that the million tons of exports that was anticipated and expected by the DFPD will not happen in its entirety, as some people in the trade may have taken positions that have turned against them. It is unfortunate because it would have helped lower the balance sheet of the country by a couple of 100,000 tons of sugar, and every reduction is important. But that is sugar that will remain unexported, according to our estimates. Turning quickly to the alcohol business, we achieved our highest quarterly production of 6.5 crore litres, driven by the full quarterly impact of the new distillery at Raninaggal. And therefore, if you do a simple multiplication, it is very much in line with the overall estimates that one has been giving of our capacities and our production capabilities going forward. The sales volume for the quarter stood at 6.2 crore litres, an increase of 53% over the previous year. The average realization for Q1 is lower, and this is due to ethanol produced from FCI rice, which accounted for 27% of our total alcohol sales. I want to pause over here and provide an explanation for this. Now, when we entered the tenders, at that particular point in time, the price for maize was about 26 rupees plus actually, closer to 26.5 rupees. And at that point in time, the relative contribution from fixed price FCI rice seemed more attractive from an operating perspective and to keep the distilleries operational, and therefore we did go ahead with that. Now there has been a change in stance by MOPNG, etc., where they have not allowed the fungibility of feedstocks from one to the other. Maize, of course, being at a higher price, and MOPNG trying to control the price of ethanol, the procurement price of ethanol. And unfortunately, that meant that people saddled with quantities of rice which needed to be processed at lower levels or the lowest levels of contribution as maize prices declined over Q1 of this fiscal year. However, going forward, we of course were procuring a lot more maize, and the price of maize has fallen even further. So from the lofty levels of 26.5 rupees, our buying average for the last quarter was approximately 23 odd rupees, slightly lower, and it will fall even further by over a rupee per kilo when we look at prices going forward. The profitability, as I mentioned, was impacted by that. It was also impacted by an increase in the internal transfer price of C-heavy molasses and some increase in fuel expenses. Ethanol constituted 92% of alcohol sales in Q1 56 compared to 91% in the previous corresponding quarter. I think it's important for us to dwell on the outlook of the sugar business. The monsoons have been very encouraging across North India and in the state of Uttar Pradesh, and they bode very well for the agricultural sector. So at the board meeting, which concluded yesterday, the board actually very closely considered and the rainfalls that has happened thus far and the incidence of pest and disease, which are all well below permissible limit thus far. It is very encouraging at this particular point in time. However, I will caveat it and say that the rains in August and September in the past 2 years are the ones that have particularly played spoil sport with the sugar season. So we're keenly anticipating that Skynet and the forecasting data that we have points towards very regular and normal rainfall over the next couple of months, which is very positive. However, that is still a prediction, and it will be a very important barometer in terms of the health of the crop. The health so far is actually quite excellent, both in terms of yield and in terms of the sugar content formation that has happened over the last few months. So at this particular point in time, all 8 sugar factories are actually looking pretty good, with a slight increase in cane area as well for our sugar factories, area under cane. We continue to make some judicious investments in our facilities to enhance our crush rate, and with a particular emphasis on efficiencies. I think there has been a particular onus in terms of improving our steam economies at our sugar factories, which will result in higher bagasse savings, which will be sold at fairly lucrative prices in the market. The prices have been pretty good over the last couple of years, and so our focus in this off-season on really single-handedly reducing steam economies should result in higher bagasse savings, which will be sold over the winter months during this fiscal year and on the next sugar year. We believe that a continuously increasing portfolio of refined sugar and pharmaceutical sugar, which is about 73% of our overall portfolio, augurs well for realizations of the company. Yes, we do have a lot of important clients that buy plantation white sugar, and so there will be a cap in terms of how much refined sugar the company can produce, but it does augur very well. The quantum of institutional customers has increased over the last couple of quarters, and there is a concerted effort as well from a realization perspective. And if you compare our realizations, I think we've actually done rather well in terms of our sugar sales and the absolute number in terms of value of sugar sales, and that is directly related to an increased amount of institutional customers that we have on a repeatable basis. With respect to the alcohol business, the outlook, the focus really is on improving the sugarcane crush, which will help improve the molasses availability and address some supply chain, improve the molasses availability for the upcoming season. With respect to grain, I think there is concerted and substantial efforts in terms of addressing and improving supply chain issues. So in terms of procurement and in terms of storage of grain, especially maize, to ensure that we do a much better job. It has been a learning process. This would be the third year that we're processing maize, and so I think we've got a great amount of competence in terms of how we procure it, how we transport it, how we store it, and I think that will factor in to the yields when we look ahead and as we get this maize crop processed. We're also hopeful that the government will address the feedstock and profitability challenges in the various feedstocks, and we hope that the government will remain committed to the EBP program. And as I say that, I attended a conference last week where an important cabinet minister made a public statement in his speech saying that the government was looking at announcing 27% in a graduated manner for ethanol blending. My own personal view on this is that we will graduate potentially based on new BIS standards, because the BIS standards are very important. And as the BIS standards, I understand, will come out for 22, 25, and 27%, that will be the graduation in terms of the total quantum. This augurs very, very well for the sector. I also believe that E85, which has been launched across 400 petrol pumps across the nation, will offer another substantial alternative for other ethanol production across the country. So, you're looking at 1,000 crore liters being absorbed this year, and with the maximum of what I've talked about could be well ahead of double that quantity in the coming few years. Of course, not all of that can be produced, so one will see an investment in additional distillation capacity across the country. Turning to the outlook of our power transmission business, the economic growth is really very, very, very positive, and we're seeing sectoral-based investments and in manufacturing across India and across certain economies around the world. The company is venturing into new products and has received encouraging results for these products. And for example, it would be in terms of compression gearbox technologies, looking at new developments, new research projects, and commissioning new products that will be in the marketplace and will hopefully add to the entire basket and addressable market segment for the company. The international market continues to be a key thrust area. Our quality leadership in the domestic market has paved the way for many overseas customers to qualify Triveni for steam turbine, pump, and compressor gearboxes. Our acceptability in the overseas markets has risen because of continuous marketing efforts and an opening of a European sales office in Switzerland. And also, of course, as a result, the recent enlistment on AVLs, which are known as approved vendor lists of certain key OEMs as well as third parties. In the defense segment, we recently completed the order for gearboxes for fast patrol vessels of the Indian Coast Guard, and we secured more orders for gearboxes. I think that bodes very, very well, because we'll be the only company in the country that actually that has complete technology for marine gearboxes within India. In addition, we're also working and continue to work on more products such as fin stabilizers and expand our service offering in propulsion shafting technologies. Looking at the water business outlook, the business anticipates good business opportunities, and funding is expected to flow from both state and central governments. Due to the gap of demand and supply of water and wastewater treatment plants, the water sector has recently actually started to receive a lot of positive outflow. And there have been a lot of significant opportunities that have cropped up in Q1 in terms of inquiries, etc., that will hopefully fructify into actual commercial bids. The new opportunities are exactly on the same lines that I talked to in the past, which includes recycle, reuse, ZLD, as well as EPC on HAM models. Sewage recycling is a new area of business, and wherever there are industries and off-takers for buying treated sewage, this model should emerge as a quite successful model in the future. And we're also targeting some foreign projects. We continue to do that, and I've spoken about that in the past as well. At an overall level, the company has implemented a series of strategic initiatives over the last few months, much more so than the past. We've recognized the fall in recoveries that we've had in our sugar business, and as a consequence, that has impacted our quarterly performance, and really a targeted focus on improving that. Now, a lot of the performance as far as sugar is concerned was, you see, sugar cane is a 2-year crop cycle. So if you had red rot in 1 year in the plant cane, whatever was converted into ratoon would give you a poorer result, both in terms of yield and recovery. Now, a lot of that cycle, that 2-year cycle, is over, and so the anticipation for the next year is actually wholly different from the season that we've had, both in terms of productivity as well as in terms of anticipated recovery. Internally, we're looking at 3 years ago as a benchmark, the weather patterns as well 3 years ago, which is very positive here, and we're hoping that weather, pest disease doesn't play spoil sport over the next 3 months before the start of the sugar season, which we anticipate, frankly speaking, just after Diwali. So Diwali actually is a little bit earlier. It is on the 20th of October, very early this year, and so soon after that we anticipate that all of West UP will start its operations. Regarding the proposed scheme, I think it's important to just close out my opening remarks with a few comments on that. The amalgamation with Sir Shadi Lal and the demerger of the power transmission business, we are still awaiting regulatory approvals. We're following up continuously with SEBI. We've received some in-course and regular questions from the stock exchanges, which have been answered to our knowledge where they will meet the satisfaction, and we are hoping that we will get that permission very, very soon. In terms of what that means in terms of progress, I think we could, broadly speaking, be on time. If anything, we could add another 30-odd days. But broadly speaking, as I mentioned, we're still anticipating Q1 of the next fiscal year, and I think we're still very much in line with that. With that, I'd like to I'd like to close my opening remarks and open up the question and answer session.
Sure, thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from Rehan Syed from Trinetra Asset Managers. Please go ahead.
Hello, am I audible?
Yes, you are.
Yeah. Good evening, and thank you for giving me the opportunity. I have a couple of questions. First, on the power transition side, the PTP order book has grown strongly, especially with the export traction. So how much of the 423 crore order book is expected to convert into revenue in FY26, and do you see margins improving in the export heavy mix for going forward or for going quarter?
I'm sorry, the second part of your question was inaudible. You'll have to speak a little slower and louder, please.
Sure, sir. I have a question regarding your power transmission.
No, I got the first one about what is executable in this year. What is the second part of your question?
Second part of my question is, do you see any margins improvement in the export heavy mix for going forward or for going on?
Right. Okay. We crossed the 400 crore milestone. We stand at 423 crores. The long duration orders in this are 182. So the balance, the simple subtraction of that would be orders that are executable this year. It would also, the typical order to delivery is about 6 odd months. It could be a little bit less depending if it's an aftermarket order, etc. So we still expect a substantial amount of book and bill to happen in this fiscal year to allow us to meet the budgeted numbers we have internally for this business. And as I mentioned, that our growth rate stands unabated. We had an increase in finished goods at the end of this quarter as some of our customers expected us, including defense orders, expected us to push out delivery into Q2 and towards the end of Q2 as well. So we're anticipating that Q2, Q3, and Q4 will certainly make up for the limited growth that we had in Q1. But the business is looking very, very promising. In terms of your question regarding the margin profile of the business, I want to add two very important things. We have grown the business. The company's invested quite substantially in the business. So it depends on where you're looking at, what type of margins you're looking at. Depreciation obviously will be higher because there has been a lot of capital investment into this business. In addition, we've also hired a lot of people, not just to train them for immediate growth, but for the future growth as well. So there is a slightly higher HR cost. That does not by any means mean that we are looking at margin dilution. But in terms of growth of margins, it will take some time over the course of this year for that growth to come into fruition as we get more orders and deliver more orders into export markets, where we're traditionally expecting slightly higher OEM margins.
Okay. Thank you, sir, for explanation regarding it. On the second question is around the maize prices. So you have mentioned a correction in maize price benefiting display margins. So apart from raw material cost, what other lever of cost optimization are you working on across business in FY26?
Yeah, excellent question. Very, very good question. So there are. Let's talk about supply chain, and then I'll talk about operations separately. From a supply chain perspective, you have to purchase maize and then you have to store maize. Maize, like any other crop, comes with small amounts of fungus, etc., and other impurities. So the first fundamental process is to improve the supply chain by dual testing, point of loading, point of acceptance as well. The second thing is the keeping quality, and I think there's been a lot of work, and we've worked with other firms as well to improve that keeping quality, to add ventilation, etc., to ensure that there is no build-up, and so that the starch content in maize does not change significantly at all over a period of time. So that is a very important step in terms of the keeping quality and the procurement strategies as far as maize is concerned. The second is with respect to operations. I think our cost of fuel and our cost of is an important contributor to our cost of production at our distilleries, especially our standalone distilleries. And therein we are doing a lot of effort, and we'll continue to. Some of it will happen now. Some of it will require some small capex. Not, but some tinkering capex will be required to further improve our steam economies, which will allow us to then reduce our secondary fuel, which is bagasse, which is very expensive. Because bagasse during the season is 2,000, 2,200, 2,500 rupees per ton, approximately during the season. But in the off season, it increases by a good 20-25% from that point, maybe even 30%. So you don't want that. You want to store the maximum amount. We're doing work in terms of raising the quantum of bagasse that the sugar factories will also have. So all of that is sort of tied in and will result in better operating results when we enter into the next supply year.
Okay, sir. Thank you for detailed explanation. It's very helpful for me. And the last question is around, from my understanding, could you provide a timeline update on the composite scheme of arrangement for with SSCN and VTB?
Yeah, I just addressed that. That was my last comment before I opened up Q&A. We stand unchanged, and our perspective is that it will happen in Q1 of the next calendar year, Q4 of this fiscal year.
Oh, okay. Okay. That's it from my side, and good luck for your coming quarter. Thank you.
Thank you. Next question is from Sudarshan Padmanabhan from Ask NDP MES. Please go ahead.
Yeah, thank you for taking my question. Am I audible?
Yes. I prefer it if you want on speaker.
Yeah, one second. Yes. Is it more clear?
It is much clearer. Thank you.
Yes. So my question is to understand a bit more on the cost structure in the first quarter. Now, historically, when we look at, the off-season expenses, how it's been apportioned, it is usually the second quarter that takes a brunt of, the overall impact and as far as profitability is concerned. I mean, just to understand, going by your, commentary, whether the entire drop in the sugar business is primarily on account of lower gross, spreads, as we call it, or is there a departure or is there a little bit change in the way the off-season expenses that has basically been booked in this quarter?
Yeah, let me explain it. Number one, let me confirm that there is no change in the practice at all in this quarter. Whatever we had been doing in the past, the same is consistently being followed. Now, in Q1, there is some part of the previous season which extends into Q1, and after it finishes in the month of April or early May, thereafter the off-season starts. So as per the accounting policy of the company, all costs relating to off-season are expensed out in that quarter itself. So it subsequently forms a part of the cost of production of the next season. So therefore, there is no change, but obviously the share of the off-season cost in Q2 is more than Q1.
Yeah, sure. So that basically will continue into the second quarter, and probably the only thing that would, change in the profitability, if at all, is if we, if the sugar realization continues to be over 41, then probably the spreads would be on the higher side. Would that be right?
Absolutely. Yeah. So therefore, as if you look at the pattern, because of such accounting, the profitability of Q3 and Q4 are substantially higher.
Mm-hmm. Okay.
So, our average realization for Q1 stood at 40.4 on a consolidated basis. So sugar prices already in the month of July were approximately that. August is pointing substantially better than what this average is. And as we go into September, that will increase because you have an early Diwali. So a lot of the buying for Diwali is going to actually happen in September. And so I anticipate that you will see, you haven't asked the question, but my view is that sugar prices are on a small gradual uptrend, as they typically are at this time of the year. We may see it a little bit earlier. We may see it a little bit earlier. The festival season is earlier.
Sure. And the cost of, the cane would more or less be similar at 37.5 as inventory, right? That's what you had kind of.
Absolutely. Of course, that sugar is produced.
Sure. So definitely, so the spread should be higher. So that's good news. Sir, coming to the ethanol side, it was heartening to see the volume increase in ethanol. But, coming to the, FCI grain, is the entire cost or the impact of, FCI rice has been taken in this quarter? Because I'm, looking at it from the point of view that if the volume continues and this baggage, is kind of behind us, then the profitability of ethanol will be substantially higher.
No, so excellent, very good question. And I think this is a strategic decision that we've taken that has not proved right. And I want to recognize that we took that decision at a point in time looking at maize prices, but it has not panned out well for us. And it accounted for 27% of our volumes for the last quarter. For Q2 production, it will be less than half that. So it is not over, but it will be less than half. less than half of what was supplied. So 27 was supplied. I would say it'll be, we're trying to minimize it as much as possible. Worst case scenario, it'll be 13 and a half. Best case scenario, it'll be even lower than that.
Sure, sir. And one final question before I join back with you is, today, when I look at on a year-on-year basis, we had an easier base as far as ethanol blending is concerned, where I think around, the blending was around 14%. But when I'm tracking the monthly blending, I think already the blending is close to 20%. Now, what is it that the government has, going forward from here in terms of rate of change, in terms of ethanol blending program? How is it going to translate into growth going forward from here on?
Okay, great question. And I'm going to just refer to a conference that I was an important conference convention that I was a part of last week, where we had one of the most senior cabinet ministers who gave a very long speech. It was a sugar technologist conference, but a very long speech about the future of ethanol and his perspectives on that. So he announced publicly that 27% blending has been approved. It is my understanding that BIS is expected to come out with standards for 22% blending, 25% blending, approximately 25%, 27% blending. It may be divided into 4, not 3, but that is effectively going to be the graduation in increase in ethanol blending for ethanol, for the EBP program. Now, with that being announced, I think Parliament is on right now, so I imagine that will have to conclude. The session will have to conclude, and then this decision will be announced by the cabinet, or rather by MOPNG officially. But I expect that is pretty much set in stone. In addition, we also have the possibility of E85. If we have the possibility of E85, the number of petrol pumps being 400, and again, the road transport minister has clearly said that he is looking for a factor increase in that. In fact, the minister was quoted in this morning's papers about 27% blending by the end of August, being announced by the end of August. So yeah, that is very much in line with the end of the monsoon session, or rather just post the monsoon session. So I see a graduation and a huge volume build-up. Now, you may ask what happens to the automobiles, etc., because all of these discussions have taken place, and it is my understanding that 25% blending is easily possible without any change in engine technology for two-wheelers and four-wheelers whatsoever. So there is nothing that needs to change between now and 25%. I think there is still a lot of consideration between what happens between 25 and 27, and I think we will learn a lot from Brazil. But that is still about a year or two away to get to 27, because you need to have that kind of production in the country. But it's very, very positive that this is the step that is being taken towards E85 as well as towards E27. The other thing, of course, is that the minister has also announced that most of the large automobile manufacturers are coming out with flex fuel cars that will be available for the Indian public. So again, it's creating that sort of harmonious ecosystem, not just for supply but also for demand for the EBP program.
Sure, sir. Thanks a lot. I'll join back with you.
Yeah.
Thank you. Next question is from Shailesh Kanani from Centrum Broking. Please go ahead.
Good evening, everyone. Is my voice audible?
Yes, it is.
Yeah. So first question is on the margin front. So we have seen margin pressure for some time now across segments. I understand for sugar we are having issues of 0238 with compression of yields. But just from your perspective, when do you expect the margins what we enjoyed in 22, 23, 24 coming back to our businesses?
So let's talk about which business, because we have our engineering business, we have our distillery business, and we have our sugar business.
So predominantly margin compression is witnessed in distillery and sugar. So if you can highlight that. Engineering is one of that this quarter I assume.
Sure. Engineering has improved, so that's
Yeah,
we don't
yeah.
have to worry about.
Yeah.
With respect to the distillery and with respect to the sugar business, let me start with the one that has been affected the most, which is the distillery business. I think that the worst is behind us. And I think as far as the distillery business is concerned, because of what I've talked about, I won't repeat everything that I've said. It'll be on the Concall transcript, which will be on our website also. I've just talked about what we're doing to improve our margins, both in terms of COP as well as, we can't do anything about sale price. It's all about COP. Be it operating strategies, be it supply chain strategies to help improve our margin structures, etc. That is all in place, and that will come very soon in these next ethanol supply year, and even before that, as we try and the rise that I've spoken about will reduce even in Q2, etc. And so you will see a natural bump up. Now, a return to the type of margins that existed in 22-23, that's a $1 million question. But I think that if the government, and this is the way that you have to look at it, if the government is announcing 27% ethanol blending, the only way you get to ethanol blending of 27% as well as as E85 petrol pumps is if more distilleries are established across the country, regardless of feedstock, be it sugarcane stream or be it grain stream. For that to happen, you have to have better margins so that entrepreneurs actually spend money in this sector. That will, of course, help not only those who have existing capacities, but also invite people to come in and set up capacity. Now, the government is, announcing this 27%, as the Honorable Road Transport Minister has done in the papers today, I think that bodes very well. So I can't give you a timeline. I can't even definitively say that we will touch that, but I certainly see margin improvement happening because of better pricing policies, because the nation needs more ethanol production. Now, with respect to the sugar business, I think that's the second part of your question. That is not a $1 million question. That is something that is a very real question that we have tackled right now. The replacement of 238 in low-lying areas is by and large, the vast majority of it is done. Okay, it still exists in higher areas across our factories, and yes, we will continuously reduce that, but the tearing hurry and urgency is slightly less. You can manage it a little bit with better seed treatment, with better pesticides and fertilizer dosage, etc., etc. And so you will see that vast improvement happening from this sugar season onwards. Now, to get back to that margin, it's twofold. One is to look at your cost of production. Your cost of production will improve if your recovery improves. We're expecting the recovery to improve. Will we touch the same recoveries as 23-24? I think it will take some time. That was a golden period. The variety was in its absolute prime. The variety is no longer in its absolute prime, and we don't have a variety that can replace it and give the same kind of results. There is a lot of work being done, but as of today, there isn't a magic solution there. But yes, we can improve. We can make a lot of improvements in terms of more yields and therefore better capacity utilization. And you can try and approach the element of cost of production through other ways and not just recovery, because there are other constituents of that as well. And that is what we at Triveni are doing in the coming season and beyond that in terms of lowering our cost of production. The next quantum is in terms of sugar pricing. Now, while FRP doesn't affect us in Uttar Pradesh, the FRP has gone up a lot, and the sugar price has not kept up. And I think there is a deep realization in the government that if we have to have enough cane for the ethanol blending program, and we have to have enough cane for consumption, and the balance can be exported, then we need to have sugar prices that are commensurate, or sugar prices increases that are commensurate. So you've seen the government, of course. Let me give you an example. The quota that was given by DFPD of 2.25 million tons for the month of August is a reduction of 200,000 tons over the previous corresponding month of the previous year. That's a very significant reduction in a high consumption month. And it is really to ensure that sugar prices follow the right trend so that we don't have a problem in the next year.
Fair enough. So that is helpful. So just one follow-up on that. What is the 023 exposure this year versus last year?
It's under 40%. It is presently under 40% versus close to 55% the previous year.
And our plan is to bring it below 25%, I guess, last time we discussed, right?
That's right. While we plan to bring it down, we are at the same time doing a very rigorous surveillance program to extend the life of the remaining 25% also.
Okay, thanks. So my second question is on capital allocation. We have been investing in our water division, and we have kind of spoken in the past many times about the opportunities over there. I think our capital employed is somewhere more than 600 crores over there. How do we see this division in terms of return profile? When do we expect 12 to 15% ROE, ROC numbers? Because currently it is less than double digit, right? So by when we expect this return profile to come?
Number one, in the case of water business, we have not made any capex in that particular business because no capex is required. So we basically carry out an asset-light business model, according to which most of the manufacturing is outsourced. This is number one. And number two, there is a working capital requirement which is definitely there in this business, and that basically depends from project to project, depending upon what billing milestones, etc. are. But by and large, you quoted a figure of 2,600 crores or something. That figure is also not there.
600 crores. Segmental assets is 600 crores, more than 600 crores. Yeah.
Yeah. So basically, I think a reasonable return actually depends. Like the way Tarun just now said, that we are looking at the projects overseas, abroad, etc. The very purpose over there is, number one, so that over there it enables you to complete the project in a timely manner, so that you are able to collect your money, come back, and you get a good return. So idea over there is to pick and choose good projects where the returns are good. So this is the direction we are proceeding into.
Okay, fair enough. Thank you, and best of luck.
Thank you.
Thank you. Next question is from Rajesh Majumdar from B&K Securities. Please go ahead.
Yeah, good evening, sir, and thanks for the opportunity. So my first question is, what is the cane crush for the sugar season 24-25 and the gross recovery for the year?
The cane crush in 24-25.
The sugar season, it is 819 lakh quintals, and the gross recovery, which is the equivalent recovery, is 10.8%.
And how does the gross recovery compare to the gross recovery 2 years ago? How much has it declined, the gross recovery in the last 2 years?
So the previous year it was 11.49, and the year prior to that was also in the same range.
So 11.5 was the peak, and now we are at 10.8.
No, but prior to that we have gone up to 11.97 on this basis. That was when we had red rot starting in a couple of our factories.
So gross recovery at 10.8, you think there is no downside now, and this can recover by, say, 20-30 basis points this year as a realistic assumption?
Well, I don't give forward-looking estimates, but you can sort of try and calculate what the impact of rain was. That was unprecedented last year, as well as the impact of disease. The impact of disease was higher than the impact of rain. I would certainly think that all going well, if there is no untoward change, then we will certainly see a significant improvement in terms of sugarcane recoveries and crush.
And crush, right. So basically, the area under cultivation also, you guided that there's been some improvement for this.
The area under cultivation has increased somewhat year on year. We've already done the surveys, so there has been an increase, low single-digit percentage, but that's still quite a lot. And that, if you factor into better yields, means that the cane availability, of course, could be better. And that is the hope, of course. And I keep giving this caveat, weather and pest and disease permitting.
Right, sir. Second is, on the alcohol policy, I mean, how should we take this FCI rice policy? Because last quarter when you had done the Concall, you had said that we'll be using maize, and suddenly we find this quarter that we've used 27% FCI rice. This, this kind of a flip-flop is giving us a kind of wrong direction in terms of what the company is really doing on its procurement. And since we were expecting that the maize will be a substantial figure this quarter, there was a disappointment in terms of the kind of feedstock that you used. So will this be a continuing thing, or will this stabilize somewhere? And I mean, can we see some kind of a constant, grain use, which can actually be more, give more steadiness to our earnings? Yeah.
Yeah. Okay. So no, you're very right. I think I don't quite recollect what I had said, but I think when I spoke to you in May, at the very end of May, maize prices had declined a lot. So that comment was relevant at that particular point in time, that this procurement strategy was going hammer and tongs in terms of maize procurement, because the maize procurement price had dropped from 26.5 rupees. At that point, it was around 23, reaching 23 plus. Now, at that particular point in time, they'd already bid for FCI rice. The FCI rice bid was done when when rice was opened up for us, or rather for ethanol blending, much earlier. And at that particular point in time, prices prevailing for maize were substantially higher, which was the rationale for it. Now, you're absolutely right. It did turn out to be a poor decision. And since we don't give you the actual blend of which grain we're using at what particular point in time, this has come as a little bit of a shock to you. One fully appreciates that. I think in terms of clarity, for the foreseeable future, we're certainly not going to be taking in any FCI rice, given where the price of ethanol derived from FCI rice is and the price of FCI rice. And I find it actually quite surprising that the price is what it is, because we have so much of it in the country. And I think the point is well taken. We will provide you more clarity in terms of what grain stocks we will be consuming in which quarter, so that you can work out the margin structure.
Yeah, thanks, sir. And my next question is on the capex in Mysore. So how much of the capex is already done, and how much is pending, and whether the defense bay will be commissioned this year?
Yeah, excellent question. So the vast majority of the capex has been committed, and it will all be executed on time as one is forecast within this fiscal year. And the tune of that is about 150 odd crores for this year, which is the total amount pending. Now, with reference to the defense bay, there are two aspects. There's the office block and the manning of that, and there's the manufacturing facility. We are very hopeful that within this calendar year, the manufacturing facility will be operable. And so the machines will be in place and production will start within this year. So it's on track with what I had mentioned in the last conference call. The office block will be complete a few months later, because we've devoted all of our energies in terms of getting the productive asset to be operable, and people can commute from the other facility with respect to any office work, etc. Yeah.
So if I could speak in a last question, although you've been sounding optimistic on the ethanol blending going to 27% extra, there's also a negative sentiment coming in from India's ongoing trade negotiations with the US to ease the restrictions on ethanol imports. While that may be debatable and you may have a different point of view, I was just wondering, as a company, post demerger, do we have any thoughts on the sugar alcohol business beyond ethanol, where we can see some kind of growth areas other than ethanol, if you have thought about any? Yeah.
So you asked two questions. I'll answer both. With respect to the ongoing trade policies, the industry associations have written to the government. We too have written to the government and said that we would like to see maize imports if possible. Now, even if it is GMO maize, the DDGS from that, it was being considered that the GMO is going to be non-GMO, but frankly speaking, talking to the poultry associations, etc., they're very happy to buy that that DDGS. So if we can import DDGS maize at competitive rates, it will allow us then to have more utilization of our plants and perhaps even some more plants to be set up across the country. So I don't see that as a negative, unless you have direct ethanol imports. If you have direct ethanol imports, it's a competing product. That is a bit of a pickle. I don't see that happening so easily at all, and I think that from what I'm hearing and understanding, it is the maize imports, direct maize imports, that could possibly happen. The government is trying to work out the modalities of GMO, which, as you know, in India is a very ticklish subject. Now, with respect to Triveni, after the demerger, looking at other things, we have some time for that demerger to happen. Yet the thought process is on, and the board is going to conduct workshops, etc., and evaluate a series of different options. I don't have anything concrete to share with you right now, just that the intent is certainly there to look at all available options that are in front of us today. Because yes, we do have good cash flows from the business that are investable, and we have to do something to regain, as well as the previous person mentioned, the margin structures that we had in 22-23.
Thank you. Before we take the next question, a request to participants to please limit your questions to 2 per participant. The next question is from Abhisar Jain from Monarch AIF. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Sir, just wanted to know that the capex in the gear business that we have been doing to take the capacity to 700 crore turnover, and which was supposed to complete by September 2026. How is the progress on that, and is it on time? Can you just give a little bit more color on that?
Sure. I just answered that question. I had partially answered it earlier as well. But in response to the previous gentleman who asked a question in terms of diversification, I had forgotten to add our Alcobev business, which has actually grown. The contributor business is profitable and is growing quite substantially, very good double-digit growth, and we continue to see that growth, profitable growth. As far as the IMFL business is concerned, that is in an incubation stage. It will take a couple of years before it starts throwing out some profitability, but it is a business that is really a sunrise business as far as India is concerned, as far as the new generation of Indians is concerned. So there have been moves in terms of diversification. They're small right now, but they certainly have large prospects for the future. Now, I'm sorry I answered somebody else's question when you asked the question. Let me return to PTB. As I had mentioned, our capex is very much underway, and it is being completed as per the track that one had mentioned and as you mentioned. So the production capability is pretty much in space. It doesn't mean that it gives us the capacity utilization. Our full capacity utilization will be a higher amount. It doesn't mean that we achieve it straight up, but it will certainly be in place on time. We're already a lot of the machines are already in place and are productive assets as we speak.
Yeah. So, sir, just clarifying. So, you had earlier mentioned the defense bay will be commissioned within this year, but also the gear capex expansion to 700 crore capacity is on time till September 26, right?
Yes, that's exactly what I'm saying. It doesn't mean that we're going to be producing 700 crores. It means the capacity is there.
Yes, of course. Yes, sure. And sir, on this defense capacity, since it will be commissioned, can you now provide some guidance on how that ramp up will be there in FY27 and 28? What is the line of sight and revenues from that multimodal capacity?
It's really a startup business. So to provide line of sight of revenues, and it's a business that is famous for delays in terms of orders. It's even in some respects it's like our water business, okay, where you just don't know when the orders are going to be finalized, etc. So when you have bid for orders, but the actual opening and award is something that is totally out of your hands, and that is the peculiarity of that business. So, with all due respect, I'm going to refrain at this point from providing any future guidance on that business.
Thank you. Next question is from Nitin Awasthi from InCred Equities. Please go ahead.
Hello, sir. Actually, my first question you have just answered a bit. In that whole pie of IMSL and IMIL that you just spoke about, one extension to that was left, which I'll ask right now. Any movement you're going to make into the UPML market because of the new excise policy in UP?
We have already started and introduced UPML brands from June of this year.
Okay, from June of this year you have introduced them in both the segments?
In one segment, in the other one we are about to do.
Okay, so is it 28 you have introduced and 42 you'll be doing it in the future? Is that understanding correct?
So we have already done 28. We'll be doing 42.
Okay.
So it could be happening this month itself.
Understood, sir. Also, our current machinery that we have, post the last expansion that we did within the IMIL segment, that machinery itself is capable of handling almost the whole packaging of a UPML product also, right? Is that understanding also correct?
Yeah, that is right. We have adequate machinery to handle both UPML and IMIL.
So the total capacity output, if at 100%, would be 9 million cases?
It would be, could you just repeat? Yes.
Yes,
annually. Yeah.
Understood, sir. So the second question that I had was something interesting you spoke about earlier when a question was asked to you about how would you be increasing margins. You spoke about a cost component within which you specifically mentioned steam. Now, steam for any grain distillation is a very heavy cost, the biggest cost after raw material cost. And of course, a lot of work is going on in this space. But would it be correct to understand, given the engineering excellence that your company holds, you will be able to make waves faster within this space? And is that some way where you're moving about? Like, what is the current consumption per liter and which is the movement, which way do you see it moving?
So I'm not going to give you the consumption per liter because then I'm going to have to give it every quarter.
Understood.
But I will say there are two things. Firstly, with respect, there are things that are low-hanging fruit, and then as I had mentioned in an earlier comment, we have just completed a consulting exercise to look at what can we do with small investments, small capital investments to further improve the steam economies in the distillation. So reduce our power cost effectively. And that is something that, so let's understand the low-hanging fruit you're going to see immediately, okay? But in terms of the most significant and telling reductions that will then have a lasting impact on our profitability, you should also see that in the near future. But we will have to time it. Firstly, we have to consider everything, which we'll be doing immediately over the next couple of weeks. Then, of course, the timing of this is dependent on when you take those little shutdowns at the distillery. Because as you can imagine, you cannot do any welding work at a distillery that operates 24 hours a day, because of the alcohol fumes, etc. The hazardous nature prevents you from doing that. So then we will have to look at what are our schedules, when will this equipment, the tag-along equipment, the vessels, etc. that need to be potentially added be in place, and post which we will have the reduction in that. But yes, you can certainly see this as a short-term measure over the next few quarters that we will be contemplating. Not contemplating, that we'll be executing.
Thank you. Next question is from Maulik Chaudhary from Monarch Networth Capital. Please go ahead. Maulik, you may go ahead with the question.
Hello, sir. Am I audible?
Yes, you are.
Yes, sir. I just have one bookkeeping question. So, out of regarding power transmission business, so out of this long duration order of 182 crores, how much is related to defense?
The largest pie is related to defense. I don't have the exact number. Actually, Rajiv is on the call. Rajiv, can you, of the 182, what percentage would be defense, what percentage would be gears? If you could answer that, please.
Roughly about 80% would be defense.
Thank you.
Okay. And what is the order execution timeline for this long duration orders?
So the gears orders will be executed in the next fiscal year, which is long term. The defense orders will be executed over the next 24 months. 24 months.
Okay.
Thank you very much. We'll take that as the last question. I would now like to hand the conference back to the management team for closing comments.
Right. Thank you, ladies and gentlemen, for joining us for our Q1 fiscal 26 results. I look forward to speaking to you in 3 odd months' time with hopefully much better news to share, both in terms of weather and in terms of performance of the various businesses, etc. This has been a relatively hard quarter. I think we've recognized that. We've really worked very hard, firstly to recognize it and then to find improvements around all of this so that we can come back with the type of profitability that we had showcased in previous quarters. The company is fully committed to excellence in all of our businesses, etc. And I hope that you will be able to see that kind of result very, very shortly. Thank you again for joining us on this call, and speak to you in 3 months. Goodbye.
Thank you very much. On behalf of Triveni Engineering and Industries Limited, that concludes the conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.
If you found this video helpful, please like, share and subscribe for latest upcoming videos. If you found this video helpful, please like, share and subscribe for latest upcoming videos.